Now, I'm a big fan of building wealth through passive investing. And for that, my favorite tool is using ETFs. I invest mostly into the S&P 500, but there are many different ETFs out there. I love them, and I think they have so many benefits. I made some videos about them in the past because I really believe in them. Having tried many various active ways, I actually always keep on coming back to using ETFs to grow my wealth. However, I can guarantee that under every video I make, at least there's 1-2 comments that ask me, but Kai, what about the ETF bubble? Now, some of you may not be aware about what the ETF bubble is or supposed to be. So that's why in this video, I want to address that topic because it seems to be on people's mind. Now, from what I understand, the first time the term was coined was by Michael Burry, a famous American investor who you may know from the Big Short movie, which was a famous movie where he basically recognized the housing bubble over in the US. He bet against it, he shorted the market and made a fortune from that. Since then, everybody thinks he's a guru, and of course, he made the right call at the time, but history is not a predictor for the future, so I always look at it with a grain of salt, and that's why I want to critically look at it, whether he's right or wrong. Now, what does he mean or other people mean by ETF bubble? If everybody, all investors in the world would together invest into the same ETF, essentially buying the same stocks and companies, the efficient market where people buy and sell wouldn't work anymore because everybody would just buy more of it and there wouldn't be any real trading anymore, right? That's the kind of logic behind it. For me, honestly, it's a little bit flawed because I cannot see any possible scenario in which all people around the world together will only buy and not sell and there will not be any trading happening. Anything is a question of price. If I offer you $1 million or euros for your house that you're living in right now, most likely you're going to be selling it, right? And the same is true with stocks, companies, ETFs. If the prices go up significantly, there will always be sellers and there will always be buyers. That's just my humble opinion. That's how markets have been working forever. So I cannot possibly see a scenario where this would be the case. Now let's also have a quick history lesson on ETFs, basically to see when they started, right? So the first American ETF was back in 1993, the SPDR by State Street, which is actually the ETF that I'm buying still these days, not the US version, but the European version, the UCITS version. So yeah, since then, people started to get familiar with the term ETF investing. Then in 2001, Vanguard, another huge player, came on board and started offering their ETFs. And then obviously other players came on board. And you see here in 2021, S&P 500 Trust ETF had over 328 billion. So obviously over the years, it has gotten much more popular, and rightfully so, right? When we look at the performance of the biggest S&P 500 ETF in the world, which is the SPY, the State Street S&P 500 Trust, you can see for the last 30 years, it grew by 1,050%. I mean, unbelievable numbers when you think about that this is purely passive investing. And in many cases, you can have an expense ratio as little as 0.03%. So obviously it appeals to a lot of people, myself included, because that's set and forget it investing and you'll get nice returns. But of course, it's not only going up, right? When people say it's a bubble, it only goes up. Well, look at the historic returns. It doesn't only go up, right? It mostly goes up, but you have many years. You can see here all the way back from 1927. Now that's the S&P 500. That's excluding the ETFs. But still, even once we had the ETFs in existence over here since 1990, you had many years. You can see here in red. In 2008, a major setback, obviously financial crisis at the time, of minus 37%. Then again, in 2022, minus 18%. So you have all these years along the way that pulls it down. So if it was a bubble, it would only go up, right? But that's not the case. Let's look at the S&P performance on a historic chart since 1929. And you see many years actually where you had major setbacks, right? And you were at the peak and people would say maybe bubble. And yes, it did fall down. But again, at the long term, it always grew. That's why we have this 8-9% annual growth over a 30-year period. That's kind of the historic numbers that the S&P had. So if it did it for so long, why would now be any different, right? We never know the future, right? Anything can happen, but it would make me really wonder why now would be any different. Now, will there be a little decline in prices and a cooling off? 100%, right? Nothing ever goes up. That's absolutely normal. But if you do think that they're going to be cheaper 10 years from now than they are now, just look at real estate, right? Do you think your house or apartment you're living or renting today is definitely much more expensive than it was 20 years ago? And guess what? 20 years from now, it will most likely be even more expensive than it was today. So if you made the point that we're at the peak of prices right now, I understand it. But is it a bubble that will burst? I just fail to see that point. Another popular argument that people talk about the ETF bubble always make is if you invest into an index, basically, you would only invest into the most popular companies in the world, right? Imagine the S&P 500, the 500 largest companies in the US, you would only be investing into those 500 companies and they would only grow more and more over time, meaning the 501 company would get hardly any capital and liquidity poured into it because everything consolidates into those 500 companies. But once again, I really disagree, because if this was the case, the companies would never change. They would always stay in the same position because there's a weighting to it, right? Number 1 has a higher weighting than number 2, and number 3, number 4. Number 500 has a much lower weighting in terms of total contribution to the overall S&P 500. So in this case, if we look at the current top 10 we see right now, the 10 biggest companies in the US, you would say, well, those companies would never change because you as a passive investor give the money to the ETF issuer and they on your behalf invest into the S&P 500 proportionately to the market value. The market cap is over here. So you can see obviously the market cap of Microsoft is higher than Apple. That's where the weighting percentages come in. However, how is it then if we go back to the S&P 500 performance since 1990, different companies at the top, right? Here we had the biggest company being ExxonMobil, followed by IBM, followed by Lowe's, the top 3. So none of them are actually now in the top 10. Well, let's move 10 years forward to 2000. Here you see, well, Microsoft started to take the top position, but then we still have General Electric, Cisco, Walmart. All those companies are not in the top 10 anymore these days. Same if we move on to 2010. All right, ExxonMobil made a comeback. Microsoft still in the second place. Then there's Walmart, then Alphabet, and only then comes Apple. So not so long ago, Apple was far from the top. So that just shows me it's not about how much money is poured into the companies, but how the companies actually operating. We've seen companies like Tesla coming out of nowhere, entering the top 10. Now that would never happen if people only invest into the ETF bubble, so to say. But people like to speculate, right? Some people have an ETF investment, but at the same time, they still want to invest into individual companies. And don't forget, there's Wall Street out there, there's mutual funds, there's closed-end funds, other big retail and individual investors, family offices, so many different parties involved into the markets, not just the ETF player, but so many other players as well. And they will be investing into things where they see the biggest capital appreciation, not just following the herd, right? Some people may do that and they may take some of the money they have to put into an ETF, but the rest, a lot of them buy actually individual positions because they're active traders. They can't just follow an ETF, they have to return superior results. And superior, in this case, means outperforming the S&P 500. So if you invest into the S&P 500, that's the results you're going to get, what everybody else is going to get. But if they want higher results, ideally that's what they promise their clients, they need to do other investments. So I think there will always be a case of people buying and selling individual shares. So I really don't believe that's a valid argument to make. And here we can look at the shareholders, for example, of Microsoft. You see here the top 25 shareholders own a total of 43%. So that's actually quite a few people involved in this, not just 2-3 big ETF players. Now, obviously, you see the big players over here like Vanguard, BlackRock, and State Street, because they are some of the biggest ETF players in the world. But those 3 together still only own less than 15%. So for me, it's really not bubble territory. If they would own 70% of Microsoft, I understand that they have power, they can control the company and so on, but they're far from that, right? So you have so many other players you can see. And now, obviously, granted, a lot of them are institutional investors, but that's normal. That's how big companies have been operating and owned in the past, right? It's not like the CEO owns 60% of the shares. That can happen for a small company, but if you become a real global player, that's highly unlikely to happen. So I think it's good to have it more diversified and so many different shareholders involved in it. Now, one thing we can see though is the rise of passive investors. Now that's granted, that's a fact, right? We can see over the years how more and more investment has become passive, but I don't believe that the active part will ever go away. On the contrary, there will be more and more people trying to outsmart the market. Now with AI, it might not be people anymore doing it, but algorithms and so on that promise investors superior returns. So I think we'll always have an active component for people with a higher risk appetite. They also want a higher return. So I think that's not going to go away. Is the passive component going to grow in the future? Most likely, right? Because people definitely understand the benefits that ETF investments does provide. I actually believe some of those active investors are behind all that ETF bubble hype because they actually losing out a lot of the fees by people investing into passive funds rather than active funds, because active funds can cost anywhere from 1 to 2 up to 3%. I've seen some fund managers taking as their management fee them to manage your investments and hopefully have superior returns. But often a lot of them are actually statistically underperforming the market. So you end up spending a significant amount of fees for lower returns over a longer time horizon. And that's why I believe Wall Street and other investors are scared by ETFs, because more and more people are getting comfortable putting their money into those passive investment ETFs rather than with banks, mutual fund, closed-end funds, all these magic investment vehicles where basically the managers in the end of the day gets a big fat bonus for managing it, hopefully providing some kind of return, but you actually losing out because that goes straight out of your returns. So I believe those might be the people behind the agenda of creating that allure of an ETF bubble and it's about to burst, and you're much better off investing with us because we are the professionals. You can trust us. And in fact, when we talk about active managers, the point that they use, them and Michael Burry, for example, talk about the concentration of money into those, let's say, 500 biggest stocks in the case of the S&P 500. But in fact, what they do is even more concentrated, right? Because they would only invest into the top 5 companies or the Magnificent 7 companies. So they're actually much more concentrated, and in that way, even worse than an ETF that at least includes 500 companies from all different sectors. A lot of them only invest into tech sectors. So for example, some boring Coca-Cola or Pepsi wouldn't get much love from them in the first place. So I believe it's actually contradictory, the point they're making over here. Now, one thing I could understand potentially is the hype around ETFs, which seems that every other day there's a new ETF coming on board, and that might be a little bit overwhelming. I mean, look at this over here. This is on Just ETF, where they pulled in all the various ETFs, and I don't think that's necessarily all of them, but yeah, a lot of them that at least listed with Just ETF. I mean, go through that list. You see so many different ETFs, and they can be all different kinds, right? I mean, the popular ones are based around certain indices. For example, the S&P 500, the Nasdaq 100, the FTSE 100, on German stocks, the CAC 40 in France, many different stock indices for different countries, which makes sense. You invest into certain countries. But then you also have global ETFs, you have regional ETFs, but then you have also thematic ETFs. If you want to, for example, invest into renewables, green energy, you could find an ETF for that, which is great, right? But then a lot of people capitalize on the latest trends. You know, now with AI being so hot, everybody wants to jump onto the AI train. By the way, I'm still scrolling here. I mean, that's crazy. And while that's nice, you could individually research into certain companies that do AI, but here some ETF providers basically say invest into that new ETF, and then that way we find for you the companies that are doing well in AI. Now that can be great, but sometimes, you know, we don't really know the whole story. We just blindly trust them. It's a new fund without a long track record. If I invest in the S&P 500, I see many years of track record. A new AI fund, that might be a bit more risky. So again, there I can see potential issues, but that's the same with any investment, right? Some investment will go up, some will go down, the same with crypto. Some meme coins will completely collapse, while some Bitcoin or some Ethereum might do much better in the future. So here, the fact that we have so many different ETFs on the market, I could potentially see that this might be a little bit misleading to some beginning investors, but still, these are passive investments at still very little cost. The majority of them are 0.3% and less. And that's a much better way than going with an active manager who often is underperforming the S&P 500. Yeah, I'm still scrolling, by the way, so that's crazy. It just shows you there's real huge selection and how popular it is as well. That also confirms my previous point. If everybody invested into the same ETFs, all of these ETFs would just collapse, right? Everybody would just pour their money into the S&P 500. But that's just not the case. There's always going to be quite a few people who say, well, Kai, that's too concentrated. You should invest in the global ETF. You should diversify to Asia, to Europe, what have you. And that's totally cool. I like those discussions. And there's no right and wrong when it comes to investments. It has to work for you, right? And you have to have conviction in it. But it also shows you that not everybody only buys the top 500 US companies, right? Some people want to invest into Europe or in Asia. And that makes it so exciting. And that's why I believe there is no bubble. It's just an investment. Now, one point of caution where I can potentially understand some of the critics that talk about ETF bubble is the fact that some ETFs actually have a synthetic replication. So you can see here some of the biggest S&P 500 ETFs outside of the US, and most of them, you can see here, replication is full replication, or elsewhere it might be called physical replication, which basically means that this ETF, the provider, on your behalf buys the actual share. They actually physically go and buy the shares, right? I mean, it's obviously done digitally, but they really own the share in the company. However, you do see some ETFs that have a swap-based, or in some other case called synthetic replication, and that's basically a really complicated derivative where they don't actually own it. It's a little bit more complicated. There I could see a potential problem. If markets collapse and people want their money, you might run into some liquidity challenges over there because they don't actually physically buy the shares behind it in the company. So that might lead to some problems down the road. That's why I'm not a big fan of that. Why people buy it? Because usually they end up having a lower expense ratio, but I'm a big fan of really physically owning the share, obviously through the ETF issuer, rather than having a swap-based or synthetic ETF. So I guess by now you understand already my point of view, how I look upon the ETF bubble. I don't think there's any bubble brewing. It's a normal market cycles. Sometimes we're up, sometimes we're down. Are we right now at rather high valuations? Yes, most likely. Will they come down a little bit? Yes, most likely, as we've seen in the past, right? There's always years where you have a downturn performance. As long-term investors, you're going to be benefiting if you continue to dollar cost average every single month from periods when it's bad, because you're going to get more shares for your money in a way. At the same time, when the price picks up and appreciates, your overall net worth will go up as well. And I'll leave you with this. Passive investing is a way to transfer money in the long term from people with access, liquidity, or capital to people who have ideas and create value. That's basically all it is, right? Nothing else, no bubble, no magic behind it. And if you believe that in 20 or 30 years, the entire world will create more value than it does today, then I believe you should continue investing and not worry about any bubbles popping anytime soon. Unless, of course, we're going to be talking about those kind of bubbles that we're going to be popping once our portfolio hits 1 million. If you still have any questions on this topic or different point of view, I'm really happy to hear from you. Let me know down in the comments below. I'll get back to every single one of you. Next up, check out this video over here. If you made it all the way until the end of the video, I really appreciate you. As always, stay healthy, get wealthy, and I'll see you in the next one. Ciao.